All right, folks, why don't we go ahead and get started? Chuck, are you with us?
Yes. Can you hear me, Tom?
Can, and you sound great. I am going to go ahead. I'm going to give you the reins, Chuck, and let's get this party started.
All right, sounds good.
It's coming over now.
All right. Okay, can you see my presentation?
Not yet.
Okay, let me go to share here.
There we go.
Okay, sounds good. Good afternoon, everybody. This is Chuck Hughes.
Chuck, can you just enlarge the screen for us there?
Oh, yeah.
The top right, just those two arrows going the opposite way.
Yes. How's that?
That looks pretty good.
Okay. All right, great. Thanks, Tom. And thanks, everybody. It's great to be here today. And I want to thank Tom for taking the time to set up these educational webinars. I enjoy doing them. And today I've got a presentation for you on option trade management, which I think is a very important part of the overall success in my personal trading and in my advisory services. So we're going to go through these trade management steps so you'll be able to see exactly how we manage trades once we put on an option trade. The market's been very cooperative this year, and we've had a lot of winning trades. And the big question when you have winning trades is, what do you do with those profits? And you don't want to close the position out and take profits if that stock's going to continue to go up. And on the other hand, you don't want to stay in the stock only to see it go down and have a winning trade turn into a losing trade. So we're going to address that today, and that's I admit, a quality problem to have. So let's take a look at how we manage our trades once we put them on. So today we'll be looking at option trade management, and we're going to be looking at protecting our option profits. And then at the end, I'll try to answer all your questions. And if you have further questions and I don't get to your question, feel free to contact my support staff, and I will get you an answer. Last month, we discussed in detail what I call the prime trade select process, and that's how we select option trades. So if we're looking at a stock, let's say Apple, and we want to purchase a call option on Apple, then we go through our prime trade select process to select a call option. And we discussed that in detail last month, so you can, or I guess that was in the July webinar. Yes, the July webinar, we discussed this in detail. So if you want to take a look at these, the details on these steps, feel free to go back to that webinar and take a look at it. So as I mentioned, Prime Trade Select has produced a lot of winning trades this year. So we're going to look at our trade management rules, and there's 3 steps to our trade management once we establish an option trade, and we'll take you through those 3 steps, and I'll show you actual examples of option trades that we have on now using these money management rules. And I currently have $862,000 in open trade profits with an average return of 93%. And my portfolios now, I have almost every position is a spread trade because I used Prime Trade Select, selected a call option to buy for Facebook or Apple or Google, and then I had a profit, and I went through this money management rules and to lock in that profit. And right now, just about every trade in my account is a spread trade using these money management rules. And I currently have an average return of 93%. And I just wanted to mention that if I didn't employ these spreads, then my average return would probably be even higher. But by using these spreads, I built in a lot of downside protection. And in the case of the market neutral strangles, no matter what happens in the market, I'm guaranteed to make a profit. So I'll show you those trades here a little later on. So right now I have average return of 93%, $862,000 in open trade profits. So let's take a look at some trade examples. And this first slide, this is for the SSO, which is the ProShares Ultra S&P 500 Index Fund. This is a 2-time leverage index fund. And what I'm going to show you is several entries that I made into these call options, and then later on I created a spread. So we used, as we learned back in July, we used the Keltner channels to help us time our entries. And the goal of the Keltner channels is we want to get a low-risk entry, and the goal is for the stock not to retrace after we purchase the call option, because if the stock retraces, we could get stopped out. So we use these Keltner channels. So this first slide here is the daily price movement of the Ultra S&P 500 Index. And as we learned in the previous webinar, we want to wait till the ETF, in this case, retraces before we establish our call option position. And we can see that this SSO has been on a strong uptrend. The question is, when do you want to jump in on this trade and get a low risk entry? So it retraced towards the lower Keltner channel, and I went ahead and bought the 65 strike call right here. And then you can see there was very little retracement from my purchase price. Here's another example. This is Cigna, again, on a very strong uptrend. You want to wait for the stock to retrace towards the lower Keltner channel, and then I went in right here and bought the 50 strike call option. Here's another example for Caterpillar. Again, another strong up move. Question is, when do you jump in? Retraced right here, so I bought the 70 strike call. Here's one more example. This is for Wells Fargo. Wait for the retracement, and then bought the 35 strike call. So in each of these examples, you can see that this stock or ETF did not retrace very much from my entry price, and that's the whole goal of the Prime Trade Select. And using those Keltner channels, I resulted in low-risk entries, as you saw, and the stocks did not retrace much from the entry point, and this helps prevent getting stopped out of your position. And here's another use of the Keltner channels. I like to focus on stocks that have repetitive and predictive price patterns, and avoid the stocks that have no trend. And here's an example. This is for Marriott, the hotel chain. We can see with the Keltner channels here that Marriott has a very repetitive and predictable price pattern. So that's another way to use these Keltner channels is, you want to focus on stocks like Marriott as opposed to Vale, the Brazilian iron ore mining company. You can see really no clear trend with Vale. So we just totally ignore stocks like this, and we just focus on stocks that have repetitive price patterns, and that's worked out really well. Here's another example. We have positions in Cheniere Energy. We can see very predictive, repetitive price pattern as opposed to Peabody Energy with really no clear trend. Here's one more example. This is for United Rentals, and again, very repetitive, predictive price patterns as opposed to Mosaic, the fertilizer company. So we like to focus on these stocks that are in strong uptrends and very predictive patterns. So, and we also use the 1% rule to select an option strike price. And once you decide let's say you want to take a trade in Apple, there could be hundreds or even thousands of strike prices to choose from. So we use this 1% rule to select the option strike price. And if with the 1% rule, we limit the time value of the option to 1% of the stock price. So the stock only needs to increase 1% in order for that trade to break even. So this will have a much higher probability of success than picking an option strike that requires, let's say, a 6 to 10% increase in order for that trade to break even. So with all our option trades, the underlying stock only has to go up 1%, and we start making money. So this greatly increases our chances of success by using this 1% rule to select the option strike price. And that's all part of the Prime Trade Select presentation I did in the last webinar. So as I mentioned, Prime Trade Select has produced a lot of winning trades this year. So now we're going to look at trade management. And the first rule we're going to look at is the what I call the 30% rule for walking away. And this is just a simple money management stop that gets us out of a trade that goes bad. And what I like to do is I look at my positions daily, and if I see that I start to lose on a call option purchase, I'll monitor that each day. And if the option price that I paid drops 20% below my entry price, then I'm going to start to look to exit, and then I will exit before it hits a 30% loss. And the goal with this money management rule is to avoid 100% loss, which can easily happen when you're trading call options. So we use the 30% rule for walking away. Here's an example. In this brokerage confirmation, I bought the J&J 80 strike call at 23.72. So each day I'll just take a look at my positions, and if the price of this option starts to drop, when it gets down to, say, around 19, which would be about a 20% drop, then I'll make a mental note that I want to exit this trade if it drops 30% to around 16.50 on a closing basis. So this is just a simple money management rule that helps us prevent a total loss of the option premium and allows us to stay in the game, because if you have several of these large losses, it can be really hard to make those up. If you have a 50% loss in an option, then on your next trade, you have to make 100% just to break even. So we like to use these money management rules, try to avoid those large losses, which can be really hard to make up. Okay, and then we have another rule, what I call, it's another 30% rule, and it's for creating option spreads. And basically, if we get a 30% or higher profit in our option, then we're going to look at creating an option spread. And this is really important to help protect your profits. And in the case of the market neutral spreads, you can actually lock in a profit no matter what the underlying stock does. So you want to start looking at protecting those profits once you get more than a 30% profit in your option trade. And then the other trade management rule we use is we want to roll over at option expiration if that stock is still on a Prime Trade Select buy signal, and the trade is profitable. So when we get close to option expiration, we'll take a look at the trade. If it's still profitable and it's still on a Prime Trade Select buy signal, then we'll go ahead and roll over that option and close out the expiring option and buy to open the new option. And I'll show you examples of that.
Chuck, I don't want to interrupt you, but
Yeah.
we're getting a lot of questions about Prime Trade Select. And for those of you that weren't on Chuck's webinar back in September of last year or July of this past year, Chuck goes into depth about the Prime Trade Select, and it is on My Trade Monster as an archive. Sorry for interrupting, Chuck. I just want to let everyone know that.
Okay, yeah, no problem. We use, so if we have a 30% profit, then we want to create an option spread to provide downside protection for that profit and to allow us to stay in the trade and be profitable in many cases, even if that underlying stock goes down, and I'll show you examples of that. So there's two types of option spreads that we trade. We trade the option debit spreads and then the market neutral strangles. And you can't get into trouble with these two types of spreads. If the market goes against you, the most you can lose would be the cost of the spread. So you can't get trouble with these two types of option spreads. I actually trade these in my retirement accounts. Okay, so let's take a look at the basic difference between a directional trade and a spread trade. The spread trades have a long and a short position, and the long position profits as the underlying stock or ETF moves up in price, and of course the short position profits as the underlying stock or ETF moves down in price. And I'll show you examples of how these spreads can profit even if the market moves up, down, or remains flat. So that's an important part of the whole portfolio management, is protecting those profits. And I'll just show you a snapshot of my brokerage accounts, and these are all spread trades, and I currently have, as I mentioned, an $862,000 open trade profit, average return of 93%. This is my account number one. I have a $627,000 open trade profit, and you can see the various spread trades are listed here in this profit loss report. And I have a combination, as I mentioned, of option debit spreads and market neutral strangles. So here's a continuation of my number one account, and here's the last page of my option positions for that number one account. And again, that account has a $627,000 open trade profit. Here's account number two, and this one has $234,000 in open trade profit. So average return in these two accounts is 93%, and even if the underlying stocks go down in this case, I'm still going to make profits. Okay, and again, it's possible for debit spreads to profit if the underlying stock increases in price, remains flat, or even declines in price at option expiration. So let's take a look at the debit spreads first, and then we'll take a look at the market neutral spreads. And the debit spread is created by buying a call option and then selling to open a related call option with a higher strike price. So this spread can be put on simultaneously, or you can purchase a call and then sell a call at a later date to leg into the spread. So it can be done simultaneously, or you can leg into the spread. And today we're going to look at spreads that I legged into because I used that 30% rule, and when I had a 30% profit in an option, then I created a spread. And with bullish debit spreads, the call option purchased will profit if the price of the stock increases, and the call option that is sold will profit if the price of the underlying stock decreases. And as I mentioned, your risk is limited to the cost of the spread. And I just wanted to mention that today we're just looking at bullish spreads, and and during the last two severe bear markets in 2008 and 2002, these were all reversed, and we had all bearish spreads, bearish debit spreads on, and we made significant profits during those bear markets. The Prime Trade Select works either way. It'll signal either bullish or bearish trades. Today we're just talking about bullish trades, but just keep in mind when the next bear market hits that this spread strategy works both ways. And we had a lot of bearish spreads on in the last bear market, as well as put option positions, and we did very well during the bear markets. Okay, so I want to show you examples of option purchases that I made and using Prime Trade Select, and then the trade worked out. I had a 30% profit, and then I'll show you how I created a debit spread. And once I created that debit spread, of course, that provided downside protection to help protect the profits. And it also, with the debit spreads, when you sell to open that call option, it increases the profit potential of the existing option purchase. And I'll show you an example of that. And then by selling the call, you also provide downside protection in the event that the underlying stock decreases in price. So let's look at an example, a trade I have on now. This is for the triple Qs. This is a leveraged NASDAQ ETF, and this is a snapshot of a profit loss report for this spread. You can see I bought 60 of the triple Q January 40 strike calls at $25.80, and I used Prime Trade Select to select this option. I waited until the stock pulled back, or the ETF in this case. I waited till it pulled back towards that lower Keltner channel, and then I went ahead and purchased these 60 of these 40 strike calls at $25.80. So the trade worked out. The triple Qs did not retrace from my entry point, and then I had a 30% profit. So at that point, I sold to open 60 of the triple Qs January 65 strike call, and I sold those at $10.85. So I had a profit in the existing call purchase, wanted to protect those profits, so at a later date I went ahead and sold the 65 strike call at $10.85. And I'm displaying the call option spread analysis for this trade, and this is a option calculator that will give us the profit potential for a trade based on various price changes in the ETF, in this example from a 20% increase in the ETF to a 20% decrease in the ETF price at option expiration. So you can see with a 20% increase, the ETF will be trading at 105. If this first row here shows the percent change in the ETF, if the ETF remains flat at 87.74, and then we also showed the results if the ETF decreases 20%. So the second row from the bottom here shows the profit potential for this trade, assuming these various price changes in the ETF at option expiration. And the 10.05 here would be a $1,050 profit, and this bottom row shows the percent return, and we can see that with this spread trade, if the underlying ETF is up at all, I'm going to get a 67% return. at option expiration. If the ETF is flat at 87.74, I'm still going to get a 67% return. And you can see I have downside protection built in when I created this spread. So even if the ETF goes down 20% to 70.19, I'm still going to realize a 67% return on this spread trade. So here's an example of a profitable call purchase and created a spread that gave me downside protection, and even if the underlying ETF declines 20%, I'm still going to realize a 67% return on this trade. So that's why we do these option spreads. We want to protect those profits. Okay, so if the once I establish this bullish debit spread, the 40-strike call option that I purchased will profit if the price of the ETF increases, and the 65-strike call that I sold will profit if the price of the ETF decreases. So we have both a bullish and a bearish component in these debit spreads. And as I mentioned before, my risk is limited to the cost of the spread. So now, when I sold that 65-strike call, the existing 40-strike call that I had purchased previously had an open trade profit. So purchased the 40-strike call using the prime trade select. The trade worked out. I had a profit. So at a later date, I sold the 65-strike call. And I sold that for $10.85. And when I did that, it almost doubled the profit potential for my existing 40-strike purchase. So that's another important advantage to these debit spreads is when you sell that call option, sell to open that call option, you increase the profit potential of your existing trade. And in this example, by selling that 65 strike at 10.85, that almost doubled the existing profit potential that I had. And of course, that provided downside protection. And I collected, when I sold that call for 10.85, I collected $1,085 in cash for each contract that I owned, for a total, in this example, of $65,000. So as soon as I sold that 65 strike call at 10.85, I collected $65,100. $65,100 was in cash, was credited to my brokerage account immediately. So that $65,000 in cash allowed me to make additional trades. So that's another important advantage to these debit spreads, is that you're selling option premium and cash is going into your brokerage account, and that allows you to make additional trades. And also, when I sold that 65 strike call, that also reduced the risk of my original 40 strike purchase from, I originally had $2,580 at risk, and that reduced it to $1,495 because I received that $1,085 in cash for each 65 strike call that I sold. So one of the big advantages of these debit spreads is that cash goes right into your account as soon as you sell to open a call option. Okay, so let's just review the option spread versus the option purchase. The advantage of the option spreads would be when you sell a call option, that provides downside protection and also reduces your risk. It allows you to maintain your position during choppy markets and helps avoid being stopped out. So if you just own the call option and the stock starts to decline in price, then you're going to lose money no matter what. If you have a call purchase, the stock goes down, you're going to lose money. But with these spreads, it's still possible to profit even if the underlying stock goes down. And then, of course, the cash received from the sale of the call allows you to make additional trades. And this is kind of interesting. This was several months ago, and I took a snapshot of my accounts at the time, and I had all spread trades on. And on this particular day, the NASDAQ was down 1.66%. That's a pretty big move. And typically, that would be a risk-off day, and your portfolio would really get slammed if you had bullish positions on, and the NASDAQ was down 1.66%. The Dow was only down 0.5%, but with the NASDAQ down that much, that would have been a risk-off day, and if you had bullish option positions, you probably would have gotten slammed. But I took this snapshot. This is kind of interesting, and you can see the NASDAQ was down 66 points when I took this snapshot, or 1.66%. Dow was down 85 points, but this snapshot of my positions shows that on that day, I actually had a small profit for these spread trades. So that just shows you the advantage of having these spread trades during market sell-offs. So what normally would have been a large losing day for me, probably in the range of 1.5% to 2% loss in my portfolio, I actually had a small profit that day. So that shows you the advantages of these option spreads. Okay, let's take a look at the second type of spread that we trade, the market neutral strangles. And as I mentioned in the beginning, Prime Trade Select has produced a lot of winning trades this year, and that's a quality problem to have, but it also poses a dilemma whether you should hold the trade for further upside or close out the trade and take the profit in case the underlying stock reverses, goes down in price, and the trade could even turn into a loss at that point. So with these market neutral strangles, we solve that problem of the winning trade dilemma, because when you create a market neutral strangle, the profit potential of the trade is not capped. It's not limited. So if the underlying stock continues to go up in price, you're going to continue to profit. If the underlying stock goes down in price, you'll have downside protection in place with this market neutral strangle. So that solves that dilemma. And with these market neutral strangles, they're created by buying a call option and buying a put option. And like the debit spreads, this can be done simultaneously, or you can purchase a call, and if you have a profit, and we use that 30% rule for option profits. So if we have a 30% profit in our call option purchase, then we'll go ahead and purchase a put to create a market neutral strangle. And I'll show you an example of that. So let's look at the attributes of this market neutral spread. The call option that you purchase, that profits if the price of the underlying stock increases. The put option purchase will profit if the price of the underlying stock decreases. And your risk is limited to the cost of the spread, and there's no limit on the profit potential of the spread if the underlying stock continues to increase in price. So let's look at a trade example of a market neutral strangle. I use Prime Trade Select to select an Apple call option purchase. I was able to get a low risk entry using the Keltner channels, and then I used the 1% rule for selecting the option strike price. So when I bought this option this Apple call option, Apple only had to go up 1%, and I would start profiting on that call option purchase. So this was set up with using the Keltner channels. I waited till Apple stock decreased in price, became oversold. It was trading towards the lower Keltner channel. I established my position, and I used the 1% rule for selecting the option strike price. So Apple stock only had to go up 1%, and I started to profit on the trade. So this trade was profitable, and once I got up to a 30% profit on the trade, then I used the 30% rule for creating option spreads. And what I did with this Apple call purchase, I purchased 50 of the Apple, the January 75 strike calls at 13.52. And then what I did is once I got a 30% profit in this position, then I traded a combination of the market neutral spread, and then with the other half of my position, I sold monthly call options against this leaps option. So I actually trade both types of spreads with my Apple position. So you can see I own 50 of the 75 strike calls at 13.52, and then I bought 25 put options, October 93.57 put options. I bought 25 of those at 3.43, and then for the other half of my position, I sold monthly call options. In this example, I sold the September 102 call at 2.11. As a matter of fact, just before I came on the air here, I rolled over this monthly call from the September to the October. So I had 50 call options, so I established 50 spreads, 25 market neutral spreads, and 25 debit spreads, and I'm selling monthly option premium on 25 of those contracts. So, and here's another interesting thing with these selling this monthly option premium. I collected 211 by selling the 102 strike call, so that equates to $211, and I get to do that 6 times. So if I got a similar premium over the course of 6 months, I'm going to collect a total of about $1,266 in premium. Now that almost reduces the cost basis of my call purchase to zero. Purchased the calls at 13.52, but I have the potential by selling that monthly option premium of collecting $1,266, which almost covers the entire cost of the option purchase. So that's another thing to keep in mind. So bought to open 50 of the January 75 strike calls at 13.52. Created a market neutral spread by buying 25 of the October 93.5 puts, and then on the other half of the position, I sold to open 25 of the Apple 102 monthly calls, and I'll be rolling that over. As I mentioned, I rolled this trade over today, and then again I'll be rolling it over in October. Okay, let's look at the profit potential on this market neutral trade, and again we use an option calculator that will calculate the profit potential for this trade, assuming various price changes in Apple stock at option expiration. In this example, from a 20% increase in the stock price to a 100% decrease. Of course, we don't expect it to decline that much, but I just wanted to demonstrate how these market neutral spreads work. So again, purchased the 75 strike call at 13.52, and then I purchased the 93.5 strike put at 3.43. So hit calculate, and then this first row displays the various price changes in Apple stock at expiration, and the second to bottom row displays the dollar profit potential for this trade, and then the bottom row here displays the percent return potential for this trade. So you can see no matter what happens to Apple stock, if it goes up, stays flat, goes down, I'm going to lock in a profit with this market neutral strangle. So no matter what happens, I'm going to profit. So if Apple stock is flat at option expiration, you can see I'll realize a 59% return. If Apple stock is up 10%, I'm going to realize a 120% return. If it's up 20%, I'll realize a 180% return. And then if it goes down, I'm still going to realize a return. And as you can see with these market neutral strangles, the more the stock goes down, the more you make. So that's a function of purchasing that put option, which profits as the underlying stock goes down in price. So if you had a catastrophic loss, you can still make money with these market neutral strangles. So again, by creating this spread, I locked in my profits no matter what the underlying stock does. So if the stock is flat at expiration, I get a 59% return. If there's a 10% increase, 120% return. So when I purchase the put option, I give up a little bit of the profit potential, but you can see with a 10% increase, I'm still going to get 120% return. So even though I give up a slight amount of the profit potential by purchasing that put, I'll still get a really good return. And with a 10% increase in the stock, I'm going to get 120% return. If the stock stays flat, I'm going to get a 59% return. So this allows you to profit no matter what the underlying stock does, and at the same time, you by purchasing that put option, you give up a little bit of the profit potential, but then you have that downside protection. So once I put these trades in place, I can just place them, forget about them. I don't have to worry about protective stops. I don't have to worry about bad earnings reports or big down moves in the stock. I just put the spread trade on and forget about it until expiration. So that's a great low stress way to trade options. And I just wanted to show you real quickly my market neutral spread portfolios. In this account, I have a $70,000 open trade profit, and this is a list of my market neutral spreads. And in this account, I have a $199,000 open trade profit. And again, this lists the various market neutral spreads I have in this particular account. So, and the interesting thing about these two portfolios is no matter what happens to the price of the underlying stock, I'm still going to make money on these two portfolios regardless. And lastly, I just wanted to cover rolling over our options, and that's our third trade management rule. And we want to roll over profitable options if they're on a prime trade select buy signal and the trade is still profitable. Then we'll go ahead and roll over at expiration. And when you roll over options, that reduces your risk, allows you to compound your returns and play with the house's money. So let's look at a few examples. And this is a closed trade report, and you can see I closed out the Google 950 strike call, and I had a gain of $7,600 on this trade. And then I also closed out the XLV, which is the healthcare ETF, I also closed out. That was a total. I had a total of 36 options. I had the June 45 strike call. So these are just the various prices that I got filled. So I had 36 of the June 45 strike calls, and this lists the profits that I had for those 36 calls. I got filled at different price points, so that's why there's 5 different prices here. But this column lists the net profits for these closeouts. So 7,600 and for Google, and I had 30-something thousand in profits for XLV. So what I did is with the XLV, I had 36 calls, and it came out to a total profit. These 5 profits here total $31,000, and then I went ahead and purchased 36 of the September 45 strike calls at $15.69. So this is at option rollover. The XLV was still in a prime trade select buy signal. I had a profit on the position, so I went ahead and rolled it over to the September 45 strike call. So the cost of the September calls was $56,500, and then my profit on the rollover was $31,000. So now that reduced my cost basis from $56,000 to just $25,000. So by rolling over, that reduced my risk by more than 50% and allows me to compound my return. So again, the cost of the new option was $56,000. I rolled over $31,000 in profits. The new cost basis is $25,000. And here's the Google example. Closed out the Google June call with a $7,600 profit, purchased the December 450 call, and the cost of the December call was $14,600. My profit was $7,600, so that reduced my cost basis to $7,000, and again, it reduced my risk by more than 50%. So that's an example of some rollover trades, and that concludes my presentation for today. So if you would like to see how these various strategies are doing, you can log on to www.weeklyoptionalert.com, and then if you click trade results, you'll see the which are updated monthly. You'll see the current trade results for these various strategies. Here's the market neutral portfolio. We have option spreads. We have covered calls. We have option purchases. So if you want to get an update and see how these portfolios are doing, just click the trade results page and you'll get the updated trade results. Or you can call Brad toll free and discuss the advisory service with him. So that's the end of my presentation, and let me see if I can pull up any questions.
Chuck, I have a question for you. I know that some of your attendees, we've gotten this question twice. They want to know how you're doing. You're a 7-time world champion trader. How are you faring this year?
Oh, that's a good question. It's really interesting. Just recently, the profit returns have really picked up in that world trading contest. So I have 150% return, which is putting me in second place, and I'm chomping at the bit to get into first place. So I'm trading away here, and I'm hoping in October that there's two seasonal tendencies that kick in the fall, and one of them is the third year of a presidential cycle. That's always been a profitable year in the stock market, and that seasonal tendency of the third year of the presidential cycle actually starts in October of the second year. So in next month, that seasonal tendency kicks in, and then, of course, we have the end-of-the-year seasonal tendency for the NASDAQ and small-cap stocks to outperform, and so I'm using both of those seasonal tendencies along with my option spread strategies that we just discussed, and I'm trading away furiously trying to get into first place. So right now I have about 150% return.
Well, Chuck, best wishes from some of our attendees are sending out the chat saying that. But nonetheless, again, for those of you that missed something, I know Chuck covers a lot of material in an hour's time. Again, there's Chuck's number. Feel free to contact his support staff. Brad can help you out. You can identify a strategy that may pertain to you that Chuck utilizes in this portfolio. Otherwise, I mentioned earlier, a lot of people keep asking about the Prime Trade Select, and we do have archived webinars. Chuck, I'm going to go ahead and take the reins over, just so you know.
Okay.
We do have archived webinars on mytrademonster.com. If you come here tomorrow, Chuck's webinar, today's webinar, will be listed on our website tomorrow. Give me one moment here, and I'll share the view with you. Right here on the right-hand side of the page, I hope you can see that. I'm not sure if you can. But on the right-hand side of the page, Webinar Archives, just click on the downward-facing arrow. You'll see the month of September, and you can download this webinar that Chuck presented today. You can play it back as many times as you like. Otherwise, I would implore you to go ahead and contact Chuck's support staff. They're very good. They're very helpful. Chuck, I really appreciate you taking the time to do this webinar today.
Okay, and I appreciate you taking the time to set it up, Tom.
Oh, I'm happy to do it. I hope I can get you out next month as well.
Okay, great. That sounds good. Yeah, I'd like to come back next month and discuss a different strategy.
Okay, sounds great. For all of you that attended today, we appreciate